Cost accounting is a specialized branch of accounting focused on tracking, recording, and analyzing the costs associated with an organization's activities. It involves the systematic process of recording, classifying, summarizing, and allocating expenditures to determine the cost of products or services. This information is crucial for management, as it supports effective decision-making, cost control, and strategic planning. For example, cost accounting helps businesses ascertain the total and per-unit cost of goods, enabling accurate pricing strategies. It also aids in identifying inefficiencies, controlling waste, and preparing budgets. By providing detailed cost data, it empowers managers to make informed choices, such as whether to manufacture a component in-house or outsource it, and to evaluate the profitability of different product lines. In summary, cost accounting is indispensable for any organization aiming for operational efficiency and financial health. Cost sheet is a detailed statement that breaks down the total cost of a product or service into its various elements, such as materials, labor, and overheads. This tool is essential for determining both the total and per-unit cost, which in turn guides pricing and profitability analysis. For instance, consider a company producing 10,000 units. The cost sheet would list direct material consumed, direct labor, and direct expenses to arrive at the prime cost. And factory overheads are added to calculate the work's cost. Office and administrative overheads, as well as selling and distribution expenses, are included to determine the total cost or cost of sales. Finally, profit is added to arrive at the sales value. This structured approach not only ensures transparency but also helps management identify areas for cost control and efficiency improvements, making the cost sheet a vital part of cost accounting. Procedure for purchasing raw materials in a manufacturing concern is a systematic process designed to ensure the right materials are acquired efficiently. It begins with the recognition of need, where a purchase requisition is raised by the stores or production department. Next, the purchasing department selects suitable suppliers, often inviting quotations for new or critical items. After evaluating price, quality, and delivery terms, a purchase order is issued to the chosen supplier. The department then follows up to ensure timely delivery. Upon arrival, the goods receiving department checks the material for quantity and quality, and a goods receipt note is prepared. Finally, the accounts department verifies the supplier's invoice against the purchase order and goods receipt note before approving payment. This structured approach ensures that materials are procured at the right price, in the right quantity and quality, and at the right time, supporting smooth production operation. Inventory turnover measures how efficiently a company manages its stock by indicating how many times inventory is sold or used during a period. A high turnover ratio suggests efficient inventory management and quick conversion to sales, while a low ratio may indicate slow-moving or obsolete stock. This ratio helps management identify slow-moving items, prevent over or understocking, and assess liquidity. On the other hand, pricing the issue of material presence challenges due to fluctuating purchase prices, the impact on production costs, and the selection of appropriate pricing methods like FIFO or LIFO. The chosen method affects reported profits and inventory values, especially during periods of price volatility. Additionally, handling losses, wastage, and scrap adds complexity to material pricing. Together, inventory turnover and material pricing are critical for effective inventory control and accurate cost determination. Time booking is the process of recording the time workers spend on different jobs or activities, ensuring accurate allocation of labor costs. Methods include job cards, timesheets, logbooks, and piecework cards, each suited to different work environments. The main purposes are to ascertain labor costs, control productivity, check wage calculations, and provide a basis for overhead apportionment. Overheads, which are indirect costs, are classified by functions such as manufacturing, administration, selling, and distribution. By nature, indirect materials, labor expenses, and by behavior, fixed, variable, semi-variable. This classification helps in better cost control, budgeting, and decision-making. For example, factory rent is a fixed manufacturing overhead, while sales commission is a variable selling overhead. Proper classification and tracking of overheads ensure that all costs are accurately reflected in product pricing and profitability analysis. Under or overabsorption of overheads occurs when the actual overheads incurred differ from those absorbed using predetermined rates. This can result from differences in output, inaccurate rate calculations, or unexpected overhead expenses. Underabsorption means actual overheads exceed absorbed overheads, while overabsorption is the opposite. To address these differences, companies may write off the amount to the costing profit and loss account, apply a supplementary rate to adjust inventory and cost of sales, or in rare cases carry the difference forward to the next period. The chosen method ensures that the true cost is reflected in the accounts, supporting accurate profit measurement and cost control. Proper handling of overhead absorption variances is essential for maintaining the integrity of cost accounting records and for making informed management decisions. Contract accounting involves tracking all costs and revenues associated with a specific contract, such as the construction of a cinema hall. All material, labor, plant, and overhead costs are recorded, and profits or losses are determined upon contract completion. For joint products and byproducts, costs are allocated using methods like the reverse cost method. For example, in a chemical factory producing both a main product and a byproduct, joint costs are apportioned based on sales value or estimated profit, ensuring each product's cost is accurately determined. This approach helps in setting appropriate prices and evaluating profitability. Accurate contract and joint product accounting are vital for industries where multiple outputs are generated from a single process or where large, long-term projects are undertaken. Cost reconciliation statement bridges the gap between profits reported in cost accounts and those in financial accounts. Differences arise due to varying methods of overhead absorption, stock valuation, and the inclusion or exclusion of certain incomes and expenses. For instance, over or under recovery of overheads, differences in stock valuation, and items like discounts received or profits on asset sales can cause discrepancy. Reconciliation process involves adjusting the profit as per cost accounts by adding or subtracting these differences to arrive at the profit as per financial accounts. This ensures transparency and helps management understand the reasons for profit variations, ultimately supporting better financial control and decision-making.